Hi everyone, um, welcome to my YouTube channel once again. And if it's your first time here, say very big welcome to you. And thank you so much for stopping by my channel. I hope you find my content useful and helpful. The major purpose of this channel once again is to explain, um, finance tasks in a very simple manner and comprehensible manner for everyone to actually understand. And what I'm going to be talking about today is preparation of bank reconciliation statements or reports in simple steps. So before I go further, my name is Iben Adeleye. I'm a chartered accountant and I like to share knowledge. So the reason why I'm making this video today is because I believe I have a very simple approach that has helped me over the years in the preparation of bank reconciliation report or in explaining the preparation to people actually, whether for the sake of their exams or for use at their workplaces. So I believe that this video is going to be very useful for you, and I'm going to make it as short as possible so that we can get the full information in a very timely manner. So basically, before I move into the principles and the steps, which are the major part of this video, and then we'll move into the tutorial and then the solution, tutorial question, and then we build a bank reconciliation report from scratch together. So before I go into all of that, I would like to explain the reason why the preparation of bank reconciliation reports are actually necessary, right? Why is it actually necessary, rather? So you all agree with me that the major places where the major source documents where we can find or where we can see information regarding our cash is actually in our cash ledger and our bank statement, right? So what I'm trying to say is that there are two major source documents where we can find information about our cash, all right? And those two source documents are the cash ledger, which is the document that is being kept by the company itself, and the bank statement, all right? And the way it is that the bank statement is meant to be a mirror of what we have in our cash ledger. But most often time, because there are some things that either of the parties actually take cognizance of that the other does not. And so because of these reasons, these balances are most often time different. And so at certain periods, we have to actually reconcile both balances to be able to get the accurate picture of our cash as at that particular period or for that particular period. So basically, um, in this video, I have two simple principles and three steps, which is going to help us, and we're going to build, like I said, a bank reconciliation report together from scratch. For the principles, I said the first one is do what the bank has done, but what the company has not done. So what I'm trying to say is that when you're trying to reconcile your balances, one of the first principle is to do what the bank has done, but the company has not done. The second principle is to actually undo what the company has done, but that the bank has not done. And for it to make sense, I would like to explain the fact that there are two approaches, right? Um, I won't be explaining the second approach because of time and because it is just the exact opposite of the first. Um, the first approach, actually, which we'll be using, is to reconcile from the cash balance. Like I mentioned, there are two cash balances, right, that we are looking at now. The one as per the cash ledger, and the second as per the bank statement. So the first approach is to reconcile from the cash balance as per the cash ledger and reconcile towards the cash balance as per the bank statement, which is what we're going to be using here. This second approach is to reconcile from the cash balance as per the bank statement and reconcile towards the cash balance as per the cash ledger. So for this principle that I'm sharing, We are working from the cash balance as per the cash ledger, and we are reconciling towards the cash balance as per the bank statement. So the first principle is to do what the bank has done, but the company has not done. I'll give a very quick example. A very quick example is the bank charges or the service fee. So the bank would have deducted, but because the company is not aware, there's a timing difference in the actions, right? So as at the time that we're reconciling our balances, there is a possibility that that deduction is not appearing on our cash ledger yet. So what do we do? That is a case of what the bank has done that the company has not done. So what do we do? I said we do what the bank has done that the company has not done. So the bank has deducted, we have to deduct. All right. The second principle is to undo what the company has done, what the bank has not done. What example can we give to this? And a very good example is the case of our if our common unpresented checks. So, for instance, a supplier has supplied our company maybe with raw materials, right? And we have issued a check for the supplier to go to bank and cash. When we do that, the double entry we would have passed is to debit our purchases or our cost of sales and credit our bank, right, or our cash. So it means that we have deducted from our cash, right? We have reduced our cash by crediting it. But it is possible that the supplier does not go to the bank immediately to cash the amount. So there is actually no movement in the cash as per our bank statement. All right. So because of this, it's possible that as at the time we are reconciling our balances, the amount in in our bank statement is actually higher than the amount the balance in our cash ledger. I hope you understand. So in this particular case, when we are reconciling, what do we do? Because we have deducted, the bank has not deducted. What do? We add back because we are undoing what the company has done that the bank has not done. I have those principles are simple. So the question you have to just ask yourself for every scenario is what has happened? If it is who has taken the action and what do I have to do? Once you understand this very simple principle, I believe you are good to go. So after talking about this principle, then we'll now talk about the steps to actually preparing this reconciliation report. The first step is to compare the balances and note where the variances are coming from. So an example of where the variance can come from is what I've mentioned, um, right? The bank charges, right, or service fee, or unpresented checks. Another example is uncredited notes or credited checks. Another example is what other example can we have? Okay, deposit in transit. Well, they have transferred money to you. You thought the money is already in your bank, but according to the bank, maybe because of network issues or whatever it is, the bank has actually not been able to see, all right, has not actually received the money. So basically, those are the three. So the second, okay, so that is the first step, rather. The second step is to apply the principle above. So when you note that there's a difference, of course, if there's no difference in the balance, there won't be any need for reconciliation. But once there is a difference in the balances, and then you're able to note where the variances are coming from, the second thing is to now apply the principles from above. That is, do what the bank has done, but the company has not done, and undo what the company has done, but that the bank has not done. So after doing that, you then move to the third step, which is to compute your adjusted cash balance, right, and compare this amounts, this balance, rather, to the balance as per bank statement. If you have done everything well, you should have, and if there is no mistake from what the company has done or in the record, in the cash record of the company, then the balances should tie. But if the balances do not tie, you have to probably retrace your steps or go back and check what has happened in the cash ledger to ensure that there are no error in the ledger. So basically, that those are the two areas we want to look at, the principles and the steps. If you have any question regarding this, please let me know in the comment section. We are going to be going to the tutorial question right now to drive home the points that I have made earlier. So this tutorial question is just for a vague company, and I said it's XYZ company, right? So I'm going to read out the question. The question, it says XYZ company is closing its books and must prepare a bank reconciliation for the following items. Bank statement contains an ending balance of $300,000 on February 8, 2018, whereas the company's ledger shows an ending balance of $260,900. So we have done the first step. We have identified the fact that there are differences, right, in the balances that we have. And so, what is now causing this difference? We'll read further. It says bank statement contains a $100 service charge for operating the account. It means that number one, the bank has deducted $100 as a service charge from the company's account. Second thing it says that bank statement contains interest income of $20. All right, interest income. So it's possible that the company must have placed, if like a fixed deposit with the bank that is now yielding interest income or whatever investment the company has made. Oftentimes, the company would not know the timing of this income, so they won't be able to recognize. And it's possible, like in this case now, at the point we are reconciling, we have not still taken cognizance of this amount in our own cash ledger. So the bank has done, but we have not done. So let's move further. XYZ issued checks of $50,000 that have not yet been cleared by the bank. So the company itself issued checks. So that is a case of what's unpresented checks, right? So we have done, but the bank has not done. XYZ deposited $20,000, but this did not appear on the bank statement. So this is an example of a deposit in transit. Maybe for whatever reason, because of maybe network issue, right? The amount is not appearing on the bank statement yet, but we would have recorded it in our cash ledger. That is another reason for discrepancy. A check for the amount of $470 issued to the office supplier was misreported in the cash payment journal as $370. So this is another reason for the difference, right? So instead of recording $470 payment to the supplier, they mistakenly reported how much? They mistakenly reported $370. So let's just go straight to the solution, right? So um, I believe you all know how I arrived at this. What I've just done is just to have a heading, right? And this format is something you can easily build on your own, right? Basically. So I said, like I mentioned earlier, we're working from the cash balance as per the what cash ledger or the yeah, the cash ledger basically. So let's just have cash balance as per as per the cash ledger, right? As per the cash ledger. And how much is that? We have 260,900 basically, right? I've formatted these two columns to be accounting. That's the reason why something like that. So the second thing is to have an area for our add. What are we adding? So we're going to drop down some spaces to accommodate other things that we'll be adding, and then we will have a column space for deduct. So what are things that we're going to be deducting? So the second step is to apply the principles we have identified from the first step. We have identified the balances and identified what are the things that are causing the differences in the difference in the balances, right? So the second thing is now to apply the principle. So the first information that we have says that the bank statement contains $100 service charge for operating the account. So that is a case of what the bank has deducted, but the company has not deducted. So what do? We do what the bank has done and undo what we have done that the bank has not done. So what do we do? We say service charge, deduct service charge. How much is that? $100, right? $100. Okay, $100. Second information is bank statement contains interest income of $20. This is also an example of what the bank has done, but the company has not done, right? And so what do? We do what the bank has done that the company has done. So the bank has added $20 as an income, right? So we also add interest income. What do we do? $20 we add. Second, the third information says XYZ issued checks of $50,000 that have not yet been cleared by the bank, right? That have not yet been cleared by the bank. So that's the case of an unpresented check. So they have issued this check possibly to a supplier, but they have not done it. So we have actually deducted this 50,000 from our cash ledger, but the company has not. We have credited it in our cash ledger, but the company has not. The company has not. The company has. The bank rather has not recognized this amount because it has not been cleared yet. So what do? We undo what we have done. That is, we add back since we have deducted before. So we have unpresented checks. Unpresented check rather. This is correct. They have $50,000. $1,000. The fourth, if I'm correct, yeah, the fourth information is XYZ deposited $20,000, but this did not appear on the bank statement. So what has happened? We have deposited, so in our own cash ledger we would have added, but the bank has not reported, maybe because of network issues or whatever it is. So what do? We undo. It's a case of what we have done that the bank has not done, right? So we undo. But we have added before because the deposit, right? We would have added before. Now we have to deduct deposit and transit. How much is it? $20,000. $1,000. The last one, right, is a check for an amount for the amount of 470. I think there's still one more thing here. Okay, I was surprised because I knew they have more information. I'll just like shift this down. All right. Okay, it's check of 470. A check for the amount of 470 issued to the supplier was misreported in the cash payment journal as 370. For the sake of explaining for the first time, I will use like the simplest route. I know some people would have just netted both and then passed the adjustment to the accurate this thing. But for the sake of explaining for the first time, I'm just going to like explain it this way. Once there's an error, the easiest thing to do first is to reverse the erroneous entry and pass the correct entry, right? Once you have mastered that, then you can now be netting off and then passing the net as a journal, right? But for the sake of explaining for the first time, let us reverse the erroneous entry and pass the correct entry. So initially, a check for the amount of 470 has been okay was erroneously reported as 370, right? So it means that we have deducted 370 erroneously before. So what do? We add that one back. Erroneous, erroneous deduction. So how much is that? 370. So we now deduct the appropriate amount. Correct deduction. Deduction, which is how much? Just 470. Hope that is clear enough. The next one is a note receivable of $9,800 was collected by the bank. Was collected by the bank. What does that mean? What does that mean? It says a note receivable of $9,800 was collected by the bank. So it means that this amount, right, that the company has been expecting to receive as was eventually received by the bank. So it is an example of what is in the bank statement but is not on the cash ledger. And since it is an inflow, the bank has added, so we have to add. So note receivable, 9,800. That is that for that. Then the last one is a check of $520 deposited by the company has been charged back as non-sufficient fund. So in this particular case now, um, the company has deposited $520, right? But as a result of the fact that um, there was not enough. money in the accounts of the depositor, right? In the account of the depositor, what has happened? The bank rather has now charged this um, as a non sufficient fund, has charged it back rather to their non sufficient fund. I believe there's a way the bank does that, but so there is a way the bank actually handles that. So, for instance, when a customer, issues a particular check, but there is no sufficient amount in in the customer's account, right, to clear that particular check. There is a way the bank, charges it to non-sufficient NSF, which is non sufficient fund, pending when, of course, the customer will have sufficient amount in the account. So in this particular case now, what has happened? The bank has deducted 520, but the company hasn't, right? So what do? We um we deduct, right? We deduct that 520 because it is what the bank has done, but that the company has not done. But the company has not done. So NSF chargeback, NSF chargeback, which is what 520. So once we are done with all of this, I believe we have done, we are done, sorting all of the issues. So but the next thing for us to do is to have a sum of everything. Have a sum of everything. For my sum, I'll just keep type is equal to alt is equal to, right, on the cell where I want the sum to be on. So now I will shift my cursor to what I'm trying to sum up, and I'll click my enter. So for that we have 60,000. So for everything I want to add, we have 60,190, and I'm going to like format this to have a border at the top, right? The top border. And then for this, I would also, pardon me, I also click my is equal to um or alt is equal to rather, pardon me, I don't know. No, sorry, the mistake there. That's my alt is equal to, then I'll shift my cursor to what I'm trying to sum up. I have 20,000, 21,090 naira. So after all of this, I'm going to copy this format, or I can just basically add my top border here as well, since that is the last thing I did. So after doing all of this, I know that the next thing is to have my adjusted cash balance, as I explained in as we have in the step three. So my adjusted cash balance will now be what? Cash balance would now be equal to this plus this minus this, right? And that's what 300,000. So let me put this in bold, put this in bold, put the balances in bold, and then this as well in bold. Then I'm going to have this also in bold because it's a balance, right? So the next thing to do after having the adjusted cash balance, also the second part of the step three is to compare it with the bank's cash balance. Actually, I can have, okay, no, let me just cash balance as per bank statement, which is where we are reconciling towards the bank statement. And we can see from our question how much. Oh, great. So the cash balance as per our bank statement is how much? 300,000 as well. Oh, I have both three. Right, so I'm going to have this in as well. So you can see this. So we compare. So in comparing, all we have to do is just to say is equal to this minus this, right? And we have this. We can have this in in the top border with its double border, double bottom border rather. So so basically that is to show that we do not have any what variance anymore after reconciliation. So basically, that is that about that. I hope you find, and this is a very good format. Is a very simple and common format that most people use. I hope you find this useful. So once you understand the principles, I believe you are good to go. Even if it's something that you are not, even if it's a scenario that you are not familiar with, like this NSF chargeback now. Once you understand what has happened, you will know where to place it. Once you understand the principle, I hope that is understandable. Thank you so much once again for coming to my YouTube channel. Please engage my content, subscribe once again, subscribe, comment, like, and share my video so that I can be encouraged to do more. Thank you so much once again. Bye. See you next time. And Happy New Year to you.